myths about market cap. I guess for our listeners who are, just starting out, why is it important to understand these nuances?
So even though it has its limitations, market cap is still a really valuable tool, especially for, everyday investors. It gives you a very quick and easy way to kind of gauge a company's size relative to other companies.
Right.
Think of it as a way to categorize companies, almost like how we categorize boxers, by their weight class.
Oh, okay. So like you wouldn't put a featherweight in the ring with a heavyweight.
Exactly. And in the same way, understanding market cap can help you avoid comparing apples and oranges, right? So for you as an investor, understanding these different market cap categories can really help you tailor your investment strategy, based on your risk tolerance and your financial goals.
Yeah, so it's all about finding that balance between playing it safe and taking calculated risks.
Yeah. Another misconception is thinking that market cap alone determines how much it would cost to acquire a company.
Okay, so we've talked about market cap, enterprise value, intrinsic value.
Right.
Is there anything else we need to kind of keep in mind when we're trying to evaluate investments?
There's one more crucial point. Yeah, don't rely on any one thing, like any single metric or factor by itself.
Okay.
But you got to look at the whole picture.
Okay.
Like a jigsaw puzzle.
Okay.
All the pieces to get the full picture.
So it's
turning finance into a beat, music and wisdom for you and me.
Good day, aspirational investors. Welcome to the Deep Beat Financial Edutainment channel.
That's right.
This is King John, the host of the channel.
My name is Jan Malton. I am the co-host of the Deep Beat channel. It's been a pleasure meeting you all out there.
We turn complex finance and investing concepts into music and wisdom.
For your ears and brain.
Exactly. Today we're going to try to, unravel a concept that gets thrown around a lot in the investing world. Market capitalization. Or, as you might hear it, market cap.
Correct.
It's a way to kind of get a quick sense of, how big a company is in the market.
Right.
As usual, I create a memorable, catchy song about market cap for beginner investors. While this term is useful for quick reference, it is also misleading. In reality, valuing business and stock is much deeper than knowing market capitalization.
Yeah, what's really fascinating about market cap is it's all about, perception. It's what the market thinks the company's worth.
Right.
Not necessarily the actual value of the company. So it's really just like a snapshot of public opinion, and it can change all the time based on news or trends or even rumors.
Right. But let's start with the basics. How is this mysterious market cap actually calculated?
Well, the formula itself is actually really simple. So you take the current price of a single share of a company stock, and then you just multiply it by the total number of shares that are out there in the market. So for example, if a company has, let's say, 20 million shares, and those shares are trading at, let's say, $100 each, then the market cap would be $2 billion.
Okay, that makes sense. But I'm wondering, if it's just based on the share price, couldn't a company with, a few really expensive shares have a higher market cap than a company that has, loads of cheaper shares?
Yeah, that's a really great question. And it kind of highlights why, market cap alone doesn't tell the whole story.
Okay.
Imagine if you have two companies. One company has 10,000 shares, and they're each priced at $1,000.
Right.
And then another company has 20 million shares, priced at $100 each. So the first company, it might seem more exclusive with that high share price, but its market cap is actually only $10 million. Compared to the second company, which has a market cap of $2 billion. So even though the share price is lower, they have a much bigger footprint in the market. And that's one of the reasons why understanding market cap can be so helpful for, people who are just getting started with investing. It lets you quickly kind of compare companies, and get a sense of their relative size.
Yeah, I'm starting to see, why it's important to have this in your investor toolkit.
Right.
But I guess if market cap is based on the share price, which, as we know, fluctuates all the time, does it even reflect a company's real worth?
Yeah, that's where things get really interesting.
Okay.
It's important to remember that market cap is driven by what people are willing to pay for a company's shares. And that can be affected by, all sorts of things, not just the company's fundamentals. So, it's kind of like that saying, a thing is worth what someone is willing to pay for it.
Exactly.
So market cap really is just one piece of the puzzle when you're trying to understand a company's value.
Okay.
But for now, let's focus on how market cap can be used to categorize companies.
Okay. This is where, those terms large cap, mid cap, and small cap got into play, right?
Exactly. So these categories, they basically just group companies based on their market cap size, which often correlates with their stage of development and the kind of investment opportunity they represent. So for example, large cap companies. These are usually companies with a market cap of $10 billion or more. And they're often kind of established players in mature industries.
So like Apple or Microsoft.
Exactly. Apple, Microsoft, or Alphabet. And these types of companies tend to offer more stability, but maybe not as much growth potential as smaller companies.
Okay.
It's kind of like the difference between, investing in a seasoned marathon runner versus an up-and-coming sprinter.
Right.
And then you have mid-cap companies.
Yeah.
And these fall between $2 billion and $10 billion. They're often in their growth phases and they're, striving to reach that large cap status. So they offer a blend of both potential and risk because, they're still establishing themselves. And then, of course, you have the small cap.
The small gas.
And these are companies with market caps under $2 billion.
Got it.
And these are often, the startups, the disruptors, the ones with the potential to really skyrocket or, to stumble.
Right.
They might hold the key to the next big thing, but they also carry higher risk, right? Because of factors like market volatility and competition. So for you as an investor, understanding these different market cap categories can really help you tailor your investment strategy, based on your risk tolerance and your financial goals.
Yeah, so it's all about finding that balance between, playing it safe and taking calculated risks.
Yeah. Another misconception is thinking that market cap alone determines how much it would cost to acquire a company. When we're talking about mergers and acquisitions, it's really enterprise value that comes into play.
Okay.
This takes into account not only the market value of the equity, but also the debt, any cash reserves the company has, and other things to paint a more complete financial picture.
It's like when you're evaluating a used car.
Right.
You wouldn't just look at the sticker price. You'd also want to know how many miles are on it, the maintenance records, any outstanding loans.
Enterprise value gives us that kind of holistic view, accounting for those financial nuances that market cap alone might miss.
This is starting to make a lot of sense.
Yeah.
So we've debunked a couple of these, myths about market cap. I guess for our listeners who are, just starting out, why is it important to understand these nuances?
So even though it has its limitations, market cap is still a really valuable tool, especially for, everyday investors. It gives you a very quick and easy way to kind of gauge a company's size relative to other companies.
Right.
Think of it as a way to categorize companies, almost like how we categorize boxers, by their weight class.
Oh, okay. So you wouldn't put a featherweight in the ring with a heavyweight.
Exactly. And in the same way, understanding market cap can help you avoid comparing apples and oranges, right? When you're looking at different investment opportunities, you wouldn't necessarily assess the growth potential of a small startup using the same metrics as you would for, a big multinational corporation.
Right.
So market cap gives you that initial context, right? It helps you frame your analysis.
It's kind of like that first impression that helps you decide whether or not to even look into the company further.
Exactly. It's basically a snapshot of what investors feel a company is worth at this very moment.
Right.
But that can be swayed by all sorts of things. News headlines, industry trends, even just rumors.
Oh, wow.
It doesn't always reflect the company's true financial health.
So it's like judging a book by its cover. Cover might look flashy, But the story inside could be a total snooze fest.
Right, and that's where enterprise value comes in.
Music and wisdom for you and me.
Stay tuned, fellow investors. After this break, we will discuss more about enterprise value and dive into another level deeper than market cap and why it is another crucial concept to understand the value of a business. Now I will leave you with the market cap song for a short break.
It shows how strong that firm might be. Let's break down the 3 key market cap.
EV.
Okay.
It's a more comprehensive way to size up a company.
Okay.
Because it considers both the equity and the debt.
So instead of just glancing at the price tag, we're taking a peek under the hood,
Yes.
checking for any like hidden dent or engine trouble.
Precisely. Like if you were buying a used car,
Okay, yeah,
you wouldn't just look at the sticker price, would you?
right.
You'd want to factor in any loans on it. Enterprise value does the same for companies.
Oh, okay.
So it's not just the value of the shares,
Right.
also any debt the company has minus any cash it's got on hand.
So in a way, EV gives us a more realistic price tag. Like it's what it would actually cost to buy the whole company, not just a share of it.
That's right.
But doesn't that make things a bit more complicated?
It does add another layer, yeah.
Okay.
But it also helps us avoid any potentially costly surprises down the road.
All right, so EV is definitely a step up from just looking at market cap.
All right,
But even that doesn't tell us the whole story, does it?
that's true.
But if a company has a, rock solid EV,
Mm-hmm.
but its business model is about to be disrupted
Oh,
by
yeah.
some new technology,
Of course.
or what if it has a fantastic product,
Mm-hmm.
but the management team is a bunch of clowns?
Right.
EV can't capture that, can it?
You're absolutely right. And that's why we need to go beyond just these numbers
Okay,
and start thinking about intrinsic value.
okay. So this is where it gets really interesting, I think.
Mm-hmm.
Intrinsic value sounds a bit more philosophical.
In a way it is. Walk me through it. What exactly is intrinsic value?
Well, intrinsic value is about getting to the heart of what a company is really worth. It's based on its core strengths, its fundamentals, and its potential for future earnings.
So it's not just about what the market thinks today, but what the company is capable of achieving in the long run.
You got it. And that's where things get really fascinating.
Fascinating and maybe a little intimidating too.
Don't worry, it's not as scary as it sounds.
So how do analysts actually figure out this intrinsic value?
We are taking another short break. When we come back, we will explore more about the concept of intrinsic value. Don't go away.
Music and wisdom for you and me.
There are a few different methods they use. One is called discounted cash flow analysis, or DCF for short.
Okay, and what does that involve?
Essentially, it's about projecting a company's future cash flows.
Like predicting how much money they'll make down the line.
Exactly. And then we discount those future cash flows back to their present value.
So we're figuring out what that future money is worth in today's terms, right?
Yes, because money today is worth more than money tomorrow. It's all about the time value of money.
Makes sense.
Remember, with intrinsic value, we're always dealing with estimates.
It's not an exact science.
It's not. It requires analysis, projections, and a bit of educated guesswork.
I see. So it's not about finding one magic number, but more about getting a range.
Yes, a range that helps us better understand a company's potential worth.
And that's where it gets really interesting, right? The difference between market value and intrinsic value.
That's where the real opportunities start to emerge, especially for savvy investors.
Okay, I'm getting why this intrinsic value thing is so important.
Powerful stuff.
It's like it helps you see past all the hype and really get what a company is all about.
Gives you that X-ray vision.
But to be honest, I'm still a little intimidated by it all.
Understandable.
Like actually using it to make decisions, that seems, I don't know.
Daunting, yeah.
Yeah.
I'll let people feel that way.
So even if I'm not like a financial expert, can I still use this?
Absolutely. You don't have to be a Wall Street wizard or anything.
Okay, that's reassuring.
The important thing is, remember that no one has a perfect crystal ball, right?
Not even the pros.
Not even the pros. Intrinsic value, it's an estimate. Well, it's an educated guess.
Okay, a range of possible value.
Right, not an exact number.
So it's more about getting a feel for whether a company's price is, reasonable or not.
Exactly. It's a framework
A framework.
to help you think about your investments more objectively.
Intrinsic value help us stay grounded when, everyone else is going crazy over the latest hot stock.
It's like an anchor. When prices get inflated, way beyond what a company's actually worth.
Just because of hype.
Right. Intrinsic value analysis reminds you to look beyond the hype and focus on the fundamentals.
What the company is actually doing, not just what people are saying about it.
Exactly. It brings you back down to earth.
It's like a reality check.
It is.
Okay, that makes a lot of sense. But even if I miss out on some short-term gains by not jumping on that bandwagon.
Sure. But it's important to acknowledge that estimating intrinsic value, it's not always easy.
There are some challenges.
There are some limitations. We need to be aware of those.
Now I'm curious, what makes it so tricky sometimes?
Well, like any tool, intrinsic value has its quirks.
Quirks?
Yeah, limitations. The biggest one, I think, is that it relies on predicting the future.
Right, and the future, that's always a bit of a wild card.
Exactly. So when we use DCF analysis or any of those other methods,
So making assumptions,
we are. Assumptions about how fast the company will grow, how profitable they'll be,
the whole economic landscape, really.
all of that. And sometimes those assumptions, well, they just don't pan out.
So there's a margin of error built in.
There is. But remember, the goal isn't necessarily to get that one perfect number.
It's more about the big picture.
It is. It's about understanding a company's worth and its potential, and then using that information to make smarter decisions.
For both buying and selling.
Yes. Okay, so we've talked about market cap, enterprise value, intrinsic value.
Right.
Is there anything else we need to kind of keep in mind when we're trying to
Yeah.
evaluate investments?
There's one more crucial point. Yeah, don't rely on any one thing, like any single metric or factor by itself.
Okay.
But you got to look at the whole picture,
Okay.
like a jigsaw puzzle,
Okay.
all the pieces to get the full picture.
So it's not enough to just glance at the market cap or even just like dive deep into their financials.
Right.
We need to consider the whole thing.
Yes. Connected.
It's like connecting the dots.
Yeah, see how everything fits together.
Okay.
It's like evaluating a teammate for a basketball team. You wouldn't just look at their height or how many points they scored last game.
Okay.
You want to see their strengths and weaknesses, their personality, how they play with others,
Right.
their overall understanding of the game.
So instead of just like trying to find like the star player,
Yeah.
we're trying to build a well-rounded team.
Yeah.
For players that bring different skills.
A variety of strengths. And that's why diversification is so key in investing.
Right.
Don't put all your eggs in one basket.
Right. Spread your investments around.
Different market caps, a different industry,
Different companies, different sectors.
everything.
Diversification helps you manage risk.
It absolutely does.
It's like what's that saying? Don't put all your eggs in one basket.
Right.
Drop the basket, you lose everything.
Exactly.
But if you spread them out, you're less likely to get wiped out by one, little thing.
Exactly. And remember, investing is a marathon, not a sprint.
Okay.
Be patient. Stay informed.
Right.
Don't let your emotions get in the way.
Hey, that's a good one. Yeah, your feelings.
Yeah, you're feeling.
So take your time, do your research, think critically,
Yes.
and don't be afraid to ask questions.
Ask a lot of questions.
The more you understand how companies are valued,
Yeah,
the better decisions you can make
absolutely.
about where to put your money.
And remember, there's no one right way to evaluate a company.
Okay.
It's a process,
It's a journey.
a journey of learning and discovery.
That's what makes it interesting.
Right, exactly. There's always something new to learn.
Always new things to learn,
New opportunities.
new challenges.
Absolutely.
Keep learning, keep exploring, and most importantly, keep that entrepreneurial spirit alive.
Love that. And on that note, thanks for joining us on this deep dive into how to figure out what a company is really worth.
Yeah, hope you learned some valuable stuff to help you navigate the market.
More confidently and clearly.
Until next time,
Keep diving deeper.
diving deeper. Appreciate your time with us until the end of this podcast. If you are keen to explore more about finance and investment subjects, subscribe to the Deep Beat channel. Our next podcast is all about options. Stay tuned, stay curious.